14th One World 82 presentation on the MRM Corporation. Our organization is made up of Michael Aguilar, CEO and Vice President of Finance, Robert Chung, Vice President of Marketing, Hugh Trin, Vice President of Sales and Forecasting, Teresa Kirkland, Vice President of Human Resources, Efrain Mendoza, Vice President of Production, and May Lowe, Vice President of Operations. Our mission statement is to provide the healthcare community with a reliable, high-quality product to meet their needs in an environmentally and economically responsible way.
My name is Hubert. I'm the VP of Sales and Forecast. So I'm going to be talking about the future plans for marketing. So as Efrain has mentioned in the past, we have been very successful with our marketing strategy, so we are going to apply the same strategies to our future. So for the price, we are going to increase the price whenever we have a newer model, because newer model, we have to pay more for the production costs, and then we have to cover all the expenses, so increasing the price will help with covering all the expenses. And we also will increase advertisement on quarters 2 and quarters 4, and quarters 1 and quarters 3 will remain constant, because quarter 2 and quarter 4 seems to be the most busiest, and quarter 1 and quarter 3 are, not so busy, so we're just gonna keep that constant. And also, this is very important. We're going to purchase the consumer preference study number 2, because it will change every quarter or every year, so we want to keep up with the customer taste or preference. Okay, next let's assume that we're going to have our Model 6 in year 7, quarter 1. So we are going to increase the price in N1 to $10.95, which is 5 cents increase every quarter. For N2 to $11.90, 15 cents increase every quarter. M3 sending us N1 increase 5 cents every quarter. The reason why we increase so much in M2 because M2 is our strongest market, so we want to place our focus more in that area right there. And M4, we only increase 3 DN currency in night stock. Why? Because we do not sell so much in night stock, but we still want to keep our market share in night stock. That's why we're just gonna increase 3 DN.
Hi, I'm Robert, and I'll be telling you about our business objectives. So our most important objective is to target specific customer needs in each area. And in order to do that, we have very specific performance reports that we purchase every quarter in order to have the most accurate and most reliable data to make our decisions. So we also want to excel in performance factors which we have decided on as a team and be the first place in the entire industry. Finally, we want to plan ahead for the future and make any necessary investments for our company's continued success. Our most important strategy is our focused differentiation strategy, which after our team meetings, we have come up with a narrow market niche where buyers' needs and preferences are met. Their attributes are specifically appealing to these members, and they're tailor-made to the tastes and requirements of the members. So in order to accomplish that, we have to use small-scale production. We can't cut our prices too low, and we also cannot raise our prices too high. So it's called a focus. That's our focus. This is an example of a consumer preference study that we purchased. It's the second one that we purchased. And it shows which area prefers which qualities and which features of the products. There are usually 3 levels of quality and features. Our performance targets include return on assets, return on equity, market share, stock price, and total net income. Our actual return on assets for year 5 and year 6 were a little bit more than forecasted, but that's okay. That means that our company is getting more return for every dollar we have invested in assets. And our return on equity is also more than forecasted, which is also a good sign because our equity is giving us a greater return. Now, this is likely because we sharply increased our price from the $10 range into the $11 range. As far as market share, we originally thought that we were going to be a low-cost provider. So it wasn't until we changed our strategy to be more focused and more differentiated that we stopped looking at market share as much, but we still had a pretty decent turnout. Our stock price is actually pretty good. So compared to the industry, we are running at 2.40 cents, $2.47 a share for year 5, and $3.92 a share for year 6. And this is actually the factor where we put a lot of our weight in. However, because other companies were able to just soar, they managed to surpass us. But nevertheless, we are still a good performer in this performance standard. As far as total net income, we have been consistently higher than all the other companies in the industry. However, in years 5 and 6, we had some excessive inventory and we had a few stockouts which hurt our profits. As far as unit production cost, it was also not our main focus. But again, we have achieved a pretty good turnout. We had a strong emphasis on production training. So in year 5, our cost per unit was only $4.38. It went up a little bit in year 6, but only $4.87 per unit. Overall, I firmly believe that our firm has achieved our objectives that we have set for ourselves. And in order to have continued success, we will reduce our unit production costs, we will close our American production plants, which have much higher labor costs, and we will move all our lines to Nystock. We will close down all the sales offices in Nystock and move all salesmen to areas 1, 2, and 3. Also, we will continue to increase our R&D. Our research and development is the main focus so that we can get the newest products, the newest models. And finally, we always set a reasonable price, not too high, not too low, for America 1, 2, and 3.
Mendoza. I am the Vice President of Production at the MRM Corporation, and today I'm going to be talking about functional strategies, marketing, operational, and financial. Operational future plans. Our company's future plans for operations is to close down our home plant in America 1 and to operate only in our overseas plant in Nystock. This will reduce our high cost of operating 2 plants and reduce our labor costs. Our initial investments towards opening the additional lines at Nystock to meet demand will be high, but we have learned that in the long run it is best to operate only 1 plant due to operation costs. Our shipping expenses will also increase because our Nystock plant will have to supply American plants, but ultimately the savings in operational costs will justify the closure. Inventory and storage expenses. We projected our planned inventory to anticipate customer demand, sales growth, and prevent stockouts. In year 5, we were able to optimize our production with quality products to meet customer demand. In year 6, though, we produced more in anticipation of growth that was not fully materialized based on our projections, which led to quite an increase in inventory storage. We were able to control the slight increase in storage expenses due to the lower cost at our overseas plant. This decision has allowed us to better manage the inventory and remain focused with our strategy. Moving on to operational strategies, I'm going to be talking about production lines and production output. Our forecasted numbers for production lines and outputs for years 5 and 6 were very close to actual data. The variances were minimal and very much aligned with our production strategy. The minor variance was the addition of a second shift in our home plant to meet our growth and future expected demands. Continuing on with marketing strategies, in total training expenses strategy, Our trending expenses for the most part turned out to be higher than planned due to replacing resignations, addition of new lines, and addition of second shift. Year 5, Quarter 1 had a high variance due to training of employees for the 2 lines added in our night stock plant. In Year 5, Quarter 4, the variance can be attributed to the training expenses for the opening of second shift. The smaller variances in the rest of the quarters were due to training expenses for resignation replacements. Functional strategies. Marketing strategies, research and development investments. In the first 2 quarters of Year 5, we were able to maintain the targeted R&D spending. The variances for Quarter 3 and 4 in Year 5 can be attributed to a change of strategy where R&D spending was increased in order to speed up development and introduce Model 5 to the market sooner. Contrary to our past strategy where we were trying to maintain a lower price, we began to take a more differentiated approach by introducing a new model sooner to increase our product pricing and cover our rising expenses. In Year 6, our approach towards R&D spending took an opposite direction as we decreased from what we had planned because we began to notice our high expenses and began to make spending adjustments.
Financial strategies. Our financial strategies were to maintain a high stock price and high total net income. In stock price, for Year 5, we almost met that goal. We were only off by 3 cents. In Year 6, we actually exceeded the goal, but ultimately we were not the company with the highest stock price. Total net income goals. In Year 5 and Year 6, we did not meet the income goals, primarily because of the operation costs associated with operating 2 plants and also with overproduction that led to excessive inventory.
Oh, hello, my name's Michael Aguilar, and today we will be talking about the financial variance analysis. Our income statement pretty much was as forecasted, yet we did have an unfavorable variance in our net income. That's due to the fact that our expenses were pretty high and we had a couple of unfavorable variances in our selling and general expenses. This includes also our cost of goods sold. Some of our variances that were unfavorable or over 25% were cost of goods sold, but that's because our company produced more units than we expected. But due to investing in training, we were able to keep our expense under 50% of sales, which gave us a higher gross profit. Our selling expense, our general and selling expense was actually unfavorable as well due to employees resigning and these salespeople selling more units that cost us to pay higher commissions than usual. Our research and development, our company focuses on giving the most up-to-date products, so we invested heavily in research and development. We thought that this would put us ahead of our competitors. Our storage expense was actually unfavorable as well due to the fact that we produced more units during the quarter because in 3 of our quarters we stocked out and we had to keep more inventory on hand, and we probably didn't sell most of our units due to the fact that we raised the price when we produced more units. That wasn't a good idea. Our net before tax happened to be unfavorable as well due to our expenses. Income tax was favorable. We actually paid less for the reason that we forecasted higher operating profits, and since we had higher taxes, that reduced our net income. Moving on to the cash flow. Our cash flow, we did pretty well. Our numbers were pretty much where we expected them to be. Our investing, we didn't do much investing because we did much of our investments in year 5. But we did do lots in financing that we weren't expecting to do, so that's where we had most of our changes. Yet we forecasted, we had unfavorable ending variances, but we did have favorable variances during the final quarter, during the year. some of our favorable and unfavorable variance were taxes paid. We actually had a favorable because we ended up paying less. Production costs was actually higher due to the fact of producing more units, increasing the market share. That kind of affected us. Moving down to CDs, we actually didn't invest in CDs in year 6, but we did invest in year 5, quarter 4, and they just happened to mature in year 6, quarter 1. And that actually worked out because it actually gave us a positive investment in our operations. Our financing was kind of a coin toss. We kind of decided to do this in year 6. In year 6, our company decided to take more control of our company and try to give our investors a bigger return. We began purchasing stocks and we also began paying our debt. But we kind of miscalculated our numbers that we were low on cash, and we actually had to get $1 million in bonds as well as get an emergency bank loan in one of the quarters that we didn't have sufficient funds. Our balance sheet was pretty much as forecasted. We just have 3 areas where we had little issues. The issues were in cash, inventory, and taxes payable, but they weren't off by a lot. Our cash was shorter due to the fact that we did a lot of moves in financing. We repurchased a lot of stocks, we repurchased a lot of dividends. No, we paid out some dividends in year 5. Our inventory was higher due to the fact that we had to produce more units. We also raised the price, so we didn't sell as much inventory as we wanted. Our taxes payable were unfavorable. We actually paid more taxes. Well, we ended up having less taxes, meaning we paid more during the year.
I will be giving an overview on SWOT analysis for the MRM Corporation. In terms of strength, we have second highest market share in terms of sales, research and development, large sales force, large return on investment, differentiate strategy in terms of quality and features, sales forecast. For example, in second highest market share, the market share is very important when it comes to which company sells more. The higher market share a company has, the higher the unit sales. Fortunately, we have been able to maintain the market share since year 3, quarter 1. This is due to the large budget spending on advertisement. On an average, from year 3 to year 6, we have expended $1.3 million on advertisement. That led our company to become the second dominator on market share. As for our weakness, we have stockouts, shortage of capital, storage costs, transportation costs, operating 2 plants. An example, stockouts. We did have 2 stockouts. This is due to a lack of available cash on hand, leading to a shortage of production. We decided to reduce our stockouts by adding 2 second shift lines to our home plant. In terms of opportunities, we have market share, stock price, net income, lower unit production costs, globalization, expanded training to employees. For example, lower unit production costs. We plan to lower unit production costs without compromising quality by adding more lines at our overseas plant. We will be closing our home plant in America 1 to reduce the unit production costs, as this will increase our income. By implementing this strategy, we will be able to sustain our business and our growth in the future. Threats. Our threats are price elasticity, change in consumer preference, competitors producing in nice stock, similar strategies, resignation of salespeople, inflation, world GDP downturn. For example, price elasticity can be a serious threat when it comes to net income. Some customers in some areas are elastic to price change and some do not. This is due to brand loyalty. According to our historical performance report, customers in America 1 and America 3 are the most elastic to price change. Starting from year 5, quarter 4 to year 6, quarter 4, the unit sales in M1 and M3 drastically dropped due to an increase in price. However, America 2 remained unaffected because the customer in that area seemed to be our loyal customer. Therefore, pricing needs to be carefully determined for the upcoming quarters in order to prevent any reduction in unit sales which might yield to a lower net income.
Lessons learned. Diversification is the key to success in picking percentage of weighing factors. Originally, our preliminary percentages of weighing factors were return on assets 35%, market share 30%, total net income 35%. That was a pretty good mix of reasonable percentages. But then we changed our final percentages of weighing factors to stock price 65%, return on assets 13%, return on equity 13%, and total net income 10%. We got caught up in the fact that our stock price had steadily increased in years 3 and 4. And that was our mistake, putting so much emphasis on one weighing factor when competing against other companies.
Our company, the MRM Corporation, has learned some very valuable lessons. We strive to be the #1 leader in the industry. And in order to become a leader, we first have to consider our shortcomings. We had a few stockouts which were caused by an improper cash flow management. And in dealing with that, we ended up creating too much inventory because we added 2 second shift lines in America 1 instead of dealing with the real issue, which was a lack of cash flows. In the future, we will be much more careful with our inventory management if given another chance to make any further decisions. Also, we did not consider that our prices were not set at a proper point. Price determination is critical to revenue generation. In year 5, quarter 2, our prices were not set at a high enough point, so our profits suffered. We will make sure that this never happens again. In our company, we have learned the important lessons of avoiding stockouts, avoiding excessive inventories, and determining the proper prices so that we have adequate profits to cover our expenses.
Okay, so now it comes to our decision-making process. This is crucially important because if we mess up one decision, then we can mess up the rest of the game. According to our company, we are a decentralized system. It means that each department make their own decision. So throughout the quarter, we schedule 2 meetings per week, 2 hours per meeting. And during the meeting, we will share our own findings. So before that can happen, our VP of operation, she would gather all the data, all the reports from our results, and then she will send it to everyone. First step, the marketing and sales forecasting department would use the results to figure out the numbers for the sales forecast. So we would run regression against 7 variables, and we would choose the highest adjusted R squared, and with the right coefficient. And then we would send that information back to our production and operation department. And from then on, they would determine the shipment orders, the sales orders purchase, and also the inventory. And we want to have our inventory at least 50,000 units in each area to prevent any stockouts. And then on the other hand, our finance and accounting department, he would analyze the financial statements, of course, and he would share his finding at the meeting. So when it comes to the actual meeting, we ask all the department, we would sit together, we would go over the result for the quarter again, and we would share our own finding, our reports, and we're going to discuss like what we should do for the next quarter. And then when we are done with our report, when we are done with discussion, we would go on to decide what to put on the decision form, which is very important, like I said earlier. And when the decision form is done, we are going to upload the decision. So because we have come to an agreement in the beginning that everyone has a chance to upload decision because we have created a bond, we have created trust with one another, so that's very important. So let's say I'm going to be uploading this week, and then for the next quarter, another person is going to upload it. So we can alternate. And then all of this information will be reported by our VP of Human Resources. She's actually tracking down all the records for us, so we're just very grateful of her. So this is our decision-making process.
The MRM Corporation has undergone a great transformation. We have gone to become the top provider of high-quality medical products over the last 16 quarters that we have been making decisions for the company. In Area 2, we did have a stock out and we did have excessive inventory, so our company roller coastered a little bit, but all the other areas were fine. And we realized what the problem was. We should not have overproduction and overprice at the same time. If both are occurring, then we have excessive inventory. We also realized that we should not have put such a strong emphasis on stock price. We should not buy back so much stock that it affects our overall profits. In year 7, we will continue to have a strong focus on R&D. We will keep on purchasing those consumer preference study reports in order to have the most accurate and most reliable data. And our company will be able to rise to become first place in the entire industry. We will visit new territories, we will innovate new products, and we will boldly go where no company has gone before.